Thomas, I guess we're back. I mean, I'm back, but you're new.
For the 30th time, we are back today, and I am so excited to be here. By the way, that was awesome.
Yes.
To the teams here at Taste Trade, it was awesome.
It's nice to know when we're in this room doing
Stuff's
the
going on.
work,
Stuff is
actually happening. Yes.
Before we start the next segment, just a quick little, because I did kick Beth out, you're right, that was a pretty good trade for you.
It was a great trade.
Probably the best trade you made in a couple of weeks.
The best one of the night for sure. I can give you that one.
One of the things that we're having fun while we're trying to change financial literacy among our younger generation, and it's a challenge. But I don't want to make it seem like we're taking it on because we love it, and we wish that we had been this proactive and aggressive with our kids and everything else. So one of the things we did is we went to TD, who's our partner in this, our marketing partner, and we went to TD and we essentially said, you know what, if we could get an interesting way for kids to participate with their parents and with their grandparents and through a uniform gift to minors account, which is a UGMA account. If you would waive all the fees, then kids could really start growing with one share of stock at a time, 1, 2, 3 shares of stock, just something like, for example, if you wanted to buy Disney, I don't even know what Disney's trading for now, let's say $40, and you wanted to buy 2 shares of Disney, normally it's cost prohibitive because of commissions and everything else. But TD agreed for 1 trade a week into perpetuity here to waive the commissions. And so if you come through our link, which supports Tasty Trade, new accounts are our lifeblood. And if you come through that link and you open up a new account for your kids through the UMG account link, it's just, not only does it support everything we're doing here, it also is a great way to build value and over time to compound real portfolio returns and understanding. Builds financial literacy. It's special, and I compliment them for jumping on board and for understanding that, and for our creative teams here for doing something that's awesome.
It's a win-win.
It's a win-win. So Tony, we are here. We are a pre-debate night, and we have, as we have infamously called her, Karen the Super Trader.
It
Hello,
says
Karen.
it
It says it up there.
It says
it's a
it right
special
there on the
guest.
screen. It says Karen Super Trader.
I don't know who made that up, but it's intimidating.
You're very embarrassed by that.
We called him Sauce Grande in the pit, and he's able to live up to it. You can live up to Karen the Super Trader.
Well, I'll try not to.
We did not make up the term Karen the Super Trader, just so you know. No. We had the first interview with you, and we posted the archive, and somebody said, you have to watch Karen the Super Trader, and it just caught on. It stuck virally. So I blame all of our listeners for that.
Okay, that's
or Tony, whichever one's worse.
Whichever one's closest.
So Karen, we're going to move. A lot of people have watched our last interview with you, and I thought it was incredibly inspirational within this little industry space, within this little sector. And I thought, and I'm not going to rehash a lot of the last interview, but I think there's a bunch of new people on tonight, and we just need to set a basis for where we're coming from. Then we're going to get into 1,000 questions that we have. We've been logging questions from our listeners and our members for months now. But just what's so fascinating about your story is, and I'm not, we said age is okay, no weight, right?
That's right.
I'm the same way.
No, actually, we're the opposite way. What am I saying? Our age limit? We're not saying our weight. No. Yeah.
So in your early 50s, around 50, 52, let's say, you decided one day to take an Investools class, and I'm fast forwarding a little bit. You decided to take an Investools class, and you signed up for their PhD program, and you went through. Back in 2002, and you went through the whole thing, and it took you a couple of years. And again, we're talking about a professional woman. You were a CFO of a small private company, and you had saved you collected a reasonable amount of wealth over the years, and you're now deciding, okay, next thing you know, I'm 50. I'm going to go through the process. I'm going to learn about investing my own capital, and then just take us through to 2007. Fast forward us through 2002 to 2007.
Well, you're right, and thank you for bringing me back, and hello to Tony. It's been an amazing ride since last May when we spoke, and I decided ultimately I wanted to be able to invest my own money. I thought, no one is going to take as much concern over my money as I am going to. So having a math background and an accounting background, I really decided I think I could do this, and started taking classes. My friend Jill and I took seminars all over the United States. We just educated ourselves, and it started there. And I thought, someday I'll retire and I will invest my own money, and that's how I'll keep funds flowing in to my bank account. So we fast forward to 2007, and by that time, I decided to resign from my company, a company that I loved, a career that I loved. But I do believe that we all have an innate desire in us to live a life of significance, and I was at that point in my life, and that means many things to many people. But I decided to start a public charity, a 501c3, and devote the rest of my life to working in that area, working in international work, mainly developing countries, and that I would live off of my investments. So I started that in 2007, and then in 2008, a man I'd known through business for many, many years approached me about managing some of his money. And that's when it takes off.
So
that's
let me
when it
just
explodes.
So we went from 2002 to 2007, and there was in 2007 you started with, let's say, about $100,000 of your own capital. Mm-hmm. And you had come up with a trading methodology that that included a lot of credit spreads and things like credit spreads and two-sided credit spreads like iron condors.
Correct.
And over the course of from 2007 to 2008, before you raised any outside capital or you got any additional funding, you made about how much money?
I raised the $100,000. I was trading to about $150,000.
Okay, so basically, you made $50,000 on $100,000. This was your first real venture into this. Now you have to understand a couple things. Karen started on the Thinkorswim platform, and that's it. And now what we're going to show you is a few $100 million later, she's still on the Thinkorswim platform with nothing else.
That's correct.
So the platform was scalable, huh?
Yes. And
but what about you? How did you go from like your own money and to did you go out and look for the funds? Did they find you? Like, did you go from, okay, like I'm gonna make this money and I'm gonna live on it? How did you ramp it up? I mean, I understand the platform can do it.
If someone told me that I was going to be here 5-6 years ago, I would have said, you're out of your mind.
Sure.
This was not planned. It was because the person who approached me about managing his money, he had known me for 20 years. And we talked about the market, and he said, if you're making that kind of return, I'm not making that anywhere else where I'm investing. Please manage some of my money for me. And I made the comment, losing my money is one thing. Losing your money is a whole different thing. And that I really did not want to take on that responsibility. But over a few months, he convinced me to start with a small amount of money. We started with $600,000. And that opened up
Okay, so again, I'm going to set the stage for the discussions we're going to have for the next 45 minutes. Okay. We start with going to a class in 2002. We ramp it up to $100,000 of her own capital, which she turns into $150,000, and then she raises, not intentionally raising, but somebody else said, hey, you know what? Why don't you manage my money along with yours? Is originally how it started. So you end up with $750,000, $800,000, some number like that, which is a significant amount of capital.
Sure.
But the amazing part of the story, this is just the beginning. So we're in 2008. Now, you remember what happened in the end of 2008. We went through a meltdown. And from the beginning of 2009, okay, and these are just some crazy statistics. You started to have some amazing results.
Yes.
And people were essentially just kind of throwing money at you. It seems like. I mean, I know I don't want to sound that crude, but it was almost like, wow, something special is going on here, and we want to be involved, more like it. So over the next couple of years, and I don't want to get into all the specifics, you essentially built up two funds.
Yes.
One fund that started in 2008 that raised in total, okay, $42 million.
Yes.
And you turned that $42 million over time with all the different, with all the different returns and everything else into a total of $95 million. Now, people can say, hey, that's just a mediocre return. I promise you, I've been around for a long time. This is not a linear business, okay? It is not linear. And Karen, what that means, Karen, is like somebody can turn $10,000 into $20,000.
Or $50,000.
It's $50,000 into 100. I've been in 30 years just buried in this business, and not too many people have turned $42 million into $95 million. But that's just Fund A. Fund B, over time, okay, you started a second fund with 1.3 million, and you ramped that second fund up in total, okay, to, if I just want to make sure I have the numbers all correct, but you ramped that fund up to about 20, there was a total of about 27 million initially invested in the second fund, of which you turned to 42 million. And then on the 42 million, you ramped that up, you raised a few more dollars, another 25 million or so, and you turned that into 95 million, to a total of 95 million. So you went from this crazy idea that, okay, I can trade with $100,000. I mean, and listen, you're as we call it, common folk.
I'm common folk.
You're common
I am
folk.
Common folk.
So $100,000, and in the end, you're managing 190 million.
That's correct.
Of which 105 million, almost. I'm ballparking it. Of which 105 million dollars are trading profits. And I don't care who you are. And I've been around SPX, S&P 500 traders my entire career. And I can promise you, if I got a room full of 300 SPX traders and grabbed them out of the pit and said, do you know there's a retail customer out there trading on the Thinkorswim platform that's made $105 million in your pit and you don't even have any idea that she even exists? They'd be like, you're out of your mind. Tony?
100%, no doubt.
They would say, they would bet.
They wouldn't believe you.
They would bet both pinkies on that one. Okay. So it's a phenomenal, I know you're going to downplay it, but it's a phenomenal story. And I think the driver behind it is the simplicity. Talk to us about how simple you keep your methodology and how simple your approach is.
I first wanted to say the reason for the second fund was the profits from that fund, the net profits from that fund all go into the charity. So it's created a very unique way of raising money.
So you're
for
a better
charity.
person than us too.
If you've ever tried to raise money, it is a tough job to be in. So this has been a blessing all the way around. So what was the question?
It's about simplicity.
Simplicity.
Because Karen,
It's not as easy as it looks in this room, is it?
It isn't. It isn't.
Karen, I think Tony and I both felt since we started the show that the if we cut out all the noise and a lot of kind of the ideas that this is so complex, and talk to us about the simplicity of how you created your business and how you make money with just a very simple approach.
Yeah, we have moved from 2008 to 2012 from a very complex environment to a simple environment. And I said in last May's show, the simpler we've made it, the better our return has been. It takes the noise out of it. You can effectively trade on watching very few technical analysis, watching very few charts, simplifying just the range that you trade in. And we have two funds sitting there. If we tried to make this very complex, we could get into trouble very quickly. So by keeping it simple, everybody in the room knows the game. Everybody knows what we're doing. There are no questions. We know where we want to trade. We know how much we want to trade. We know when to stop trading. So one of our powerful strategies is to keep this all simple and to keep it narrowed basically and a few indexes.
Okay, so let's talk about that. So you told me earlier today, you told Tony and myself that a light bulb went off kind of late 2009-ish,
you're right.
okay, going into 2010. And prior to that, you had traded mostly iron condors and
Right.
credit spreads.
Right.
And starting, which you did amazing doing that, but starting in 2009, late 2009, 2010, you started to get more into what we would call some naked positions and some naked strangles, things like that. Can you talk to us about, first, we'll start off with the products that you trade up to today, the products that you trade today.
From the products I traded originally.
That's right.
We traded, I mean, there were times we had 30 stocks going as far as options. We've always been in options. And we were trading in iron condors, but we would leg into them. But basically, we followed about 30 stocks. And then we started whittling that down to about 10. Found that was so much easier to do, so much simpler. And then little by little, we got burned a couple of times on earnings. And I know you have some special strategies for earnings. But trading the way we traded, we got burned a couple of times with some earnings months. And then we started saying, well, we won't trade those options on those stocks in those earnings months. We'll just stay away from that. Little by little, we said, well, let's go into indexes. Let's look at the index. It takes us out of the earnings season. It takes us out of a lot of the volatility. It smooths it out a little more. And gradually, we just moved into the SPX, NDX, and the Russell.
So now, hey, Linda, let's throw up just some slides just so people can see some of the stuff that we're talking about. First, the SPX, and we just put some slides together so you can see. So the SPX is the S&P 500, and we'll leave that up for a second. Then we'll put up the NDX, and then we'll put up the RUT so you can see. Now, would you say today that most of your trading today is in the SPX?
Yes.
And the reason that you use the SPX is because you've actually got a little too big to trade the spiders. If you had a smaller account, you'd probably trade the spiders?
Probably if I was trading my personal account, I'd probably be in SPY, IWM, QQQQ.
I mean, if you're just a normal person with like 600 grand to
Yes,
throw
if you're-
around, that kind of thing, right? A smaller account.
I've been there. Yes, but with the SPX, you get, it's very liquid. We can trade the way we want to trade. We get the premium we want to, we get a good premium, and there's a tax advantage to the SPX. 1256 contract, so 60%, for right now, 60% is taxed as long-term capital gain.
Right, 60, 40, 28% max.
Right.
Yeah. So there is, so now we're focused on kind of one product, but let's take it a couple steps further.
Okay.
We believe that there is a lot of logic in the number of occurrences. When you started to ramp up your trading, were you also able to ramp up, as we call it, the number of occurrences? Meaning, do you, even to this day, do you remain relatively active?
We're very active.
Okay, explain what
Very
that means.
active. As far as our trading
Yes.
goes, we are putting contracts on mainly in the next month, and we're closing them down for profit and putting those back on. We're theta traders. Theta means everything to us. Using that time decay in options, and when that time, when our positions get into the current month, we pretty much leave them alone and let them expire, and we're already out in the next month working. So depending on volatility, if the volatility is higher, we flip these. We call them just churning, just selling and buying back, selling and buying back, as long as we can pull as much time value out of it as possible. And then when that dries up, we usually just let them expire worthless.
There is a term, it's called laddering, which means that you would do, like, for example, right now, November is 30 days, December is, 55 or 60 days, that kind of thing. And then January is whatever, 90 days. That we would call that laddering out positions. Do you have a certain time frame that you look for when you're making trades? Like if you were to look at a blank screen and you can choose the perfect number of days to expiration for your methodology, how many days would that be?
It's 56. It's just a number we use because it's 8 weeks. We look at getting the maximum time value, but we want that to start decaying and I think Theta starts decaying around 45 days. So we're trying to get as much time value, but we don't like to get way out in the future. December is getting close, and we'll be trading December first of next week probably.
That's
but I don't want to
56
get
days.
in. I don't want to get in. Really?
Yeah, 65 right
Amazing.
now.
But I don't want to get in January. I just not knowing what the market's
Right.
going to do. I don't want to be stretched out
Do
that
you
far.
find yourself with the volatility, low volatility environment that we have now, that you're going out a little bit further than you're comfortable with, or I mean,
Not
sticking to
really. We're
sticking to
pretty
the
much
basics?
sticking to it. It's brought our returns lower. We're
Mm-hmm.
still having a decent year, but it is lower because
As long
of
as
the
we're above
volatility.
ground, we're doing good, right?
Hey, we haven't had a losing month yet, so I'm okay with it. But
Good.
it is lower.
56 days is actually a little bit longer than our wheelhouse, but it's at the outside end of our wheelhouse. But
Okay.
what's fascinating about that is that the longer you go out, actually, the more you kind of define your risk. So I assume that's one of the reasons it's a little less risky when you go out a little bit further, because you can get a little wider.
We get wider.
Right.
We love that.
So when you look at positions, because I think what everybody wants to hear are the specifics.
Okay.
So the first specific that popped out was that 55, 56 days, because the industry has a tendency now to go towards a shorter time frame. Like, do you use weekly options?
We have. We've been kind of testing the waters this year. I can't say I'm a big fan of the weeklies.
Sure.
Probably will trim that down. But with the low volatility, we've been able to make some profit in the weeklies. Still, our bread and butter is going out the 56 days.
Now, we've had, I think most people it would be fair to say that if you were managing $100,000 and I said you're up 30% this year and we're just heading into the fourth quarter right now, you would say, okay, Tony, that's an amazing return. You did a great job.
No doubt.
But just to put Karen in perspective here, she's managing right now about 95 million total. And this year she's up 30% net going into the fourth quarter. So, and that's after fees and everything else, 30%. I just want to put this discussion into perspective, because the numbers this is a tough year. Volatility's, we're hovering around,
14, 15%.
So
Right.
so let's take the next. So we've got to 55 days. Now let's talk a little bit about some of the strategies. Like if you were to employ, as you said, early next week, maybe a December position. Let's talk about some of the things that you may do.
Well, we trick ourselves. We pretend like the market has fallen. So under the old saying that the market only crashes down, the market doesn't crash up. So we feel like we have to protect ourselves the most on the downside. We've had some difficult times this year with the move up on the upside. But we say the market is lower than what it really is, and then we go 12% below that. We use the Analyze tab on Thinkorswim, and where the current number is, we pretend like that number's already dropped. Right now we're looking at around 1370. We're saying the market's at 1370.
So you're at 1450, the real market, and you kind of make up this fictional 1370.
We pretend.
Okay.
It's really at 1370, and then we drop it down 12% below that.
And then you take it down 12% below the
that.
1370, which generally takes you to a probability of being in the money of about what?
Probability of being in the money of about 5%.
Okay. So, Tony, we've been doing a lot of experiments with that probability of being in the money. Karen, you'd have loved the stuff we've been pumping out research-wise. But the probability of being in the money of around 5%. Tony, can you show what that means?
Mm-hmm. Got it here.
Okay.
So you're looking basically at the 1220 puts in December is where I am right now.
Okay, and that would be, and Tony, just hold your cursor to the probability of being in the money at 5%. And Karen, I hate to keep going back to this, but I wanted everybody to understand that's all you have. I mean, that's all you look at.
Yes, but
Okay.
with the amount of money that we're talking about, we will trade very actively around 1220, maybe 1225, 1215, and we'll turn that 2 or 3 times.
And will you also now when you say you'll trade that means your opening trade is to sell those.
Let's sell. Yes.
Right. Now, what about the upside? When you sell those puts, will you also sell a corresponding call because it requires no additional capital?
No, we leg into each side. We will sell calls, but we sell them. Today would be a terrific day to be selling calls.
Okay.
Why?
The market was up. Not having everything in front of me today, I haven't seen the
understand.
market today.
I just want to
But
get it. I just want to get across that you sell on an upswing as
we
opposed to
sell
selling
an
a
upswing
downswing.
and
You're
then
contrarian.
sell puts on a downswing because again we can get further out. We're trying to widen that as much as we can. We watch. We have Bollinger Bands on our SPX chart at 2 standard deviations. We want to be out from that. The upside is a much greater challenge than the downside. If I'm trading down at that level, I'm not worried about it. I'm really not worried about it. If the market falls that hard, we're in trouble for a lot more reasons than just this.
Then your upside
So,
protection.
Mm-hmm.
So
the upside, it's tough. We're probably a little closer in and looking more around the 10% on the upside.
So let's take a look at what that means on the upside, Tony. And then Linda, after Tony's done with this, if you could throw up what a strangle is on the board, that'd be great.
So you look at approximately the 1540s or the 1545.
We would look at that, and then we'd look at our charts. We'd see where we thought a strong resistance level was. We would make sure we get above that resistance level. So all that comes into play when we're looking at the upside.
And would you sell an equal number of upside and downside? Or is it
Not
some
necessarily.
kind of ratio?
Not we're a little softer on the upside. We'll sell more on the put side. We can make more money.
Okay.
And be safer. Be out further.
So let's talk a little bit about what you just talked about there. Is your target, and I think this is the most interesting thing about what you do as compared to what a lot of how we trade. Number one, you're a little uneven when it comes to the amount of sells that you have on both sides of the market, and your focus seems to be more on premium collected rather than on the mechanics of being equal on both sides of the market.
It is driven by the Analyze tab, and where we are 10% up from the current position and where we are 12% down. We watch that. That is compared to our net lick, and we just don't want to be pushing up close to that net lick. So that drives us much more than number of contracts or whether our positions are even or not.
So it's more of a buy. We've said this for many years. It's much more of you're managing your buying power reduction as it relates to your net lick.
Yes.
More than you're managing some kind of mechanics around a specific standard deviation move.
Yes, I would say that. Uh-huh.
Okay.
Yes.
I'm getting the emails because you've said it a few times. Now, our conspiracy theorists that are in the audience are thinking that maybe you're that Kaiser Sosa type of person where, you're that the they that we've been looking for, the we, the they. Please tell us who we is. Is it a team of 60, 600?
It's a team of 6.
6.
5 traders and 1 number cruncher.
Gotcha.
So,
and that number cruncher goes over all of the volatility in all of the market?
The traders do that. The number cruncher tells me how much money I made every day.
I just want to make it clear.
So let's get back to this. Let's get back to this discussion because I'm trying to get lots of different takeaways for our members. And the next takeaway is so people have a big issue. So here's the amazing thing about what you've done is you did the what everybody thought was the impossible, which is scaling a logic that everybody gets the logic here, but scaling it. So you're, and again, I want to go back to this. You're in your mid 50s and you're basically rolling the dice big time. Because at some point, okay, you're not holding back. How much capital are you committing at this point in your life? Like we're talking 2009, 2010, 2011. How much capital are you committing of the total capital when you trade? Like I might commit 20% or 15%, or Tony maybe 20 or 25%. I don't know what it is, but you're up there.
we've got a suggestive target of 50% capital committed.
Okay.
And that'll range, we'll commit up to 70%. It depends on the situation, 70 to 80%, and then we'll try to pull it back. At any given time, we may be stretched a little further out than we want to be. I love 50%. I love having a bank sitting there that if the market moves on me and I need to move some positions, I've got the capital to do it. So I don't have to sit there, and I don't put stop losses on. I
never use a stop loss?
Never use a stop. I hate stop losses.
Okay.
I want to manage my account. I don't want anything automatically happening to my account. We've got 5 people sitting there watching this all day. We don't need to put stop losses on.
I love the fact that you just said that. But continuing to move in the same direction. So you commit a significant amount of capital. Obviously, if everything's going good, all right, no harm, no foul. But let's talk about all of a sudden now something happens. It could be an event. It could be a one-time binary event. It could be something. Who cares what it is? It could be the flash crash of 2010. It doesn't make any difference. But you have these very large positions on. Although they're liquid products, there are they don't always make people comfortable. We like to define risk through size. Meaning keep our size small, define your risk. You are much more of an all-in trader. You're not all in, but you're more in than most people. Otherwise, you couldn't get to these numbers. What do you do what's the mental stop point? First, what's the mental stop point? And then what do you do when the trades go against you?
I'm more all in, but at a much further out range. And that's how I justify that in my mind. Our first goal is to not lose anybody's money, and that's very important to me. So staying out 5%, sometimes we're at 1% of probability of being in the money. What do I do? How's the best way to just...
Well, let's put it this way. Let me ask the first question is, where is that mental stop? Is it if you're 5% out of the money, is the first spot that you get concerned about at a 10% or is it at 30%?
From that?
Yes.
If a position moves up to 30%, then we're just keying in on it, saying, what are we looking at? What's the problem here? What's happening to the market? Could this position get into trouble quickly? If we're not comfortable leaving it where it is, we start what we call tweaking it. We will move pieces of it. We'll roll a part of it up. Let's say it's a call.
Sure.
We'll roll a part of it up.
You're being tested to the upside.
We're being tested to the upside. We'll move a part of it up. We'll put on some more puts in a position where we feel safe.
So let's give an example here.
Let's give an example here. The difference.
Tony, let's go to a 10% out of the money call. Okay, I'm sorry, where it's 10% chance of getting in the money. We had it up there before in the SPX.
1540.
The 1540 line there, you can see the market is 350 at 430. This is December. Now, assuming you sold this, let's just say, for example, the market started to rally up. Now, are we looking at the December? Are we looking at the 1490 in December as that being kind of that 30% chance of being in the money, as you can see at the top of the page, or are we going to kind of a November option?
So what Tom's saying is,
no.
Oh, go ahead.
We're looking at the December.
So it's December versus December.
Getting into that position getting into.
Okay. So if your new probability of being in the money on the 1540 call was actually 30%, that's a trigger to you.
That's a trigger.
That I got to start looking at something, see what the market's doing, what's my assumption on the overall market, and then either do something by rolling up the calls or selling more puts.
If it's gone from 15 to 30, it needs my attention. I need to be watching it, and we're watching it as it moves up. But at 30, we're saying it's time to do something.
And time left in the expiration would also come into play, right?
So I made the comment last May that since we're selling premium, once we get the money, we're not giving it back. And what I mean by that...
Yeah, you said that in the first interview. We got a lot of emails about it. So
if that position gets into trouble, and let's say, for simplicity's sake, it brought in $1,000.
Sure.
And I may have to spend... if I have to spend $2,000 to roll it up and get it out of trouble, I'm going to get some money from some premium by rolling it up. I'm going to make up the difference on the put side, or I'm going to put a few more contracts on the call side. But
Okay, so let's
safe
understand.
further out, and also maybe sell some puts.
This is a fundamental difference between the way almost everybody trades, including myself. This is not kind of a traditional methodology for rolling up a tested side. The traditional methodology would be to roll up something else or to, make an adjustment, whatever. What you're saying is, and I just correct me if I'm wrong, but what you're saying is you get to that point where the mental number kicks in, where you go from a 10% to 30% chance. And the next adjustment that you're making is you're either rolling out in time to reduce your delta risk.
Yes.
You're either covering some of that position and which costs you money, and then to make up for that, you're selling more of the other side, in this case, a put side, to make up that same money so you don't so that theoretically when everything expires, you're back at the same spot.
Back at the same spot. I don't care where it comes from. I don't get emotional about any position. Let it go. Fix it. Do whatever you have to do to just make yourself whole at expiration date. So we don't care what it takes as long as it makes sense in what we're doing. We try to make these decisions where we're not putting ourselves in greater risk. But if the market's been moving up like that, and say we've got puts on that we put on at 5%. Probability of in the money, they're probably now down to, less than 1%.
Sure.
We can put more puts on higher. We can maybe go 10% if we need to, but with the knowledge that what the market is showing us, that's a pretty safe bet at that point. So whatever it costs us to get the call out of trouble, we make that difference up somewhere.
Have you and please show the 5% number up there too, Linda, 5% of the money. Have you effectively gamified trading to just a numbers game? Like did you, like, in your mind before we thought of this, because I like to take credit for everything, before we thought of this, did you effectively somehow gamify this so that, not that you knew that 5% equals 1.64 standard, but did you try to make it into a numbers game? You don't have a market opinion, do you?
I don't, and I love that word. It is a big board game to me. I mean, I just love it, and that's why I enjoy playing it. It's a challenge. But I see it as a big game. It's numbers to me. So when you can put that objective viewpoint into it, and you don't have feelings wrapped up in it, and it's just, I look at the numbers, and I know what it means to take a loss, and we have taken losses, but overall, percentage-wise, we have heavy percent that are winners because we just look at the numbers. It's just an unemotional process that we go through.
Has your biggest loss been larger than your biggest gain in a month time period? Pretty close?
No. I'd have to think about that. I mean, we've had no losses in a month this year. Last year, we had 1 month that we had a loss, and that month was
November.
August. Then slam dance. In August, the margin requirements changed on us, and we had to close down positions to get our analyze tab back into sync. It happened instantaneously. So without any warning, we had to just go in and start closing positions down. And that created a loss.
Is there
for the month.
I get a lot of questions regarding some of the ways you trade with respect to, we love the simplistic nature of it. Simplistic strategic approach, simplistic underlying, meaning very few underlyings, very, very, very low key on the analytical stuff, and a very low key approach to the markets in general, not trying to overanalyze, and no noise from the outside, no news, very little technicals, everything. And so is there a delta number? Like, is there amount of directional risk where you start to get uncomfortable, or is it all tied into that 30% number?
Honestly, it's tied into the 30% number.
Wow.
You may be able to teach me some things that I can do better, but what we've worked worked through for the last few years, we just tied into that 30% number.
30 years of trading says that I can't. 30 years, and God knows I've tried.
I can second that.
It works for us. It works for us. So,
So
if it ain't broke, don't fix it, sort of philosophy.
I completely understand that. Do you get into a situation where you will use multiple products? So, for example, you said that your primary product is the SPX, which is the S&P 500. But will you get into a situation? I'm not talking about pairs trading. I'm talking about like where you have a position on it in the SPX. Will you potentially, because there's a higher volatility in the RUT or a higher volatility in the NASDAQ and the NDX, would you consider trading different products, and do you look at those positions having some relationship to each other, or are you pretty independent in the positions?
It's independent. We had one year, I don't remember off the top of my head, that we made more money in Russell than we did in the SPX, and that's very unusual for us. It was just a good year for Russell. I think maybe it was 2009. With our analytical work, honestly, the SPX just comes out on top over and over and over. So we sit there and think, well, why would we want to put a trade on the NDX when we can get a greater rate of return at the same risk level on the SPX?
Now,
Why do that?
The normal retail trader's trading 10 contracts at a time. I know you're trading significantly higher. Do you have any problem finding liquidity in the SPX or anything like that?
No, none at all. And we're trading high numbers of contracts.
Sure.
So
The reason we don't trade SPY is cost.
Sure.
When you're trading that volume, if I was doing it for myself,
Commission-wise, it's 10 to 1.
I'd be back.
Sure.
I'd be back in the SPY.
there is there's a lot of discussion that goes on all the time about the need to use and we do it on the show a lot. We feel it's important to mix up different strategies. I mean, maybe you've gotten to the point where that's more of a nuisance than it is, but do you still find yourself kind of going back to the well sometimes, especially when volatility is in that 13-14% range like it is now? Do you find yourself going back to kind of some old school choices, like, and say, you know what, we should do a big wide iron condor here. We should do, I mean, do you ever do credit spreads or iron condors anymore?
No, we don't, because we found are you ready for this, Tony?
Go ahead.
The naked place.
I love it when a Southern girl says naked. There's nothing better in the whole world.
You know I'm not from upstate New York. We can just get so much further out. We just stay with the low volatility it's given us a real challenge this year. So we just told our clients we would have lower rates of return this year because of the low volatility.
You made 30% through 3 quarters. They better not be complaining.
My expectations are always higher. I like to dream bigger, and then it just comes in the way it comes in. After a year like last year, our investors have a lot of fun seeing the bigger returns, but I just said this year with the low volatility, it's just too difficult, and we still want to stay in trading in those safe ranges.
There's just based on normal marketplace cyclicality and based on trends that we've seen over the years, volatility on volatility is, just under 100%. So the expectations for the VIX, for example, to trade next year close to 30, as much as it's going to trade 15, those chances are highly likely. So
can't wait.
So is it a can't wait, or is it like, are you going to get hurt in that process of going from 15 to 30? Or how do you defend that, I guess, is the best way?
That's where the dancing becomes really tricky. The going from a high volatility environment to a low volatility, or vice versa, low volatility to high volatility. Those are some dangerous grounds. I did the analogy, it's like trying to turn a battleship around in a river. It's just so difficult, and it's time consuming. We watch that. We talk about it as a group. That probably makes me as nervous as anything. It's when that switch takes place. If you're loaded up on the downside and you have one of those days, it can make life very difficult.
Is it a group decision, as a dictatorship is a group decision, or is it really a group decision? I mean, there's 6 of you. You could be 3-3 and split.
It's usually we talk about all the different choices. And we agree as a group. We've got a tremendous trading group in that small room. We have CPAs and lawyers and people who have traded for a long time. And we all think very similarly, but I love it when people come in with different ideas and we discuss it. And
Let's talk about that group for a second.
Vital listening to those discussions.
Those are your friends.
Yes.
Those are retail customers too.
They are all retail customers.
Okay, I just want to be clear that
Yes.
this is not, you didn't come to Chicago, walk on the floor and say, hey, you, and you in the blue coat, the red coat, and the green coat, come with me to wherever home is, okay? You basically, you're talking about your friends that went to the same Investals class
Met
that you
one
did.
of the lawyer met him in an Investools class.
Okay.
It's an incredible story.
Yeah,
really.
it's freaking people out right now because so many people have similar they're all thinking, how come she didn't meet me?
Jill and I kept talking about that bagel shop we wanted to open, and we just started trading instead and found out that we probably made more money trading than cooking bagels.
Probably. It's just a guess. Yeah.
They're all people that have
so
been friends
let's
over
talk
years.
about, I have a couple more questions that I really want to get in there. I hope you don't mind. Can you go a few minutes over?
Sure.
Okay. So there's so all of a sudden volatility goes from 15 to 25%. Now the question that everybody asks is, okay, well in hindsight, if it stops at 25 and goes back to 15, you're a genius. But what if it goes from 25 to 40? Like at what point, Karen, do you say, because you're laddering out your positions 55 days.
Right.
At what point are you saying we should be all in at 28% or we should be, 20% in? Like the hardest thing for people that are listening is they're all thinking scale. Okay, this woman scaled up somehow, but I can't scale up. And I got to tell you, it's not easy. I get it. So how does that work?
Oh, gee, I don't think about it that way. We
Okay.
just do what we do every day, and as more money comes in, we just look at our analyze tab, and we increase the number of contracts. We're still playing the same game. We're still in the same position. We just increase the number of contracts.
So when the money rolls over, you just keep doing it.
But keep in mind, we pretend as if the market's already dropped. So we start at a minimum of 100 points down. So if the market starts falling, the idea is we've got time to start adjusting our positions, reducing our positions. We've got time in one of those strong downfalls to react to it and manage it and
But you
and
basically go
either
10% probability of success to the upside and 5% to the downside, correct?
yes. Mhm.
But okay, so when you do that, because this is important takeaway,
Okay.
when we were traders and trading index products the same way, we would always maintain short premium and short delta, which means we had some short directional protection on. You essentially, through however you got there, you got to the same spot. So your primary position is you're always, based on what you just said, you're always kind of short a little delta and
Yes.
you're short premium.
Yes.
And the assumption is if volatility expands, the velocity of the down move that's going to protect you in the velocity of a down move. Flash crash 2010, May 6th, 2010.
Great day in the market.
Yeah, dark day. Everything
Dark
shut
day.
down.
Yes, Jill and I were sitting there by ourselves. We hadn't expanded to this level back then, watching
Do
the
you
market
turn
do
over
that.
your screens the way we do sometimes if the market's not going the right
That's a-
direction
that's a
just to
good
make
idea.
the chart
We
look
didn't
the
try
right
that
way?
that day.
Try it. It
We
works very
were-
well. I've been doing it for 30 years.
Black tape works too, but what'd you do?
We talked with Thinkorswim on the phone several times, and we pushed positions out. So you're sitting there, the Dow's falling 1,000 points in 10 minutes. You don't know if Armageddon is hitting. You don't know what's happening. And we just moved positions out. We increased positions where we had to, but we went out into October, November. We're sitting there in April. We essentially gave up our profits for a few months to get into some kind of safe territory. We went into the bomb shelter is what we were trying to do.
Okay.
Was just push everything forward, give us time so we can see what in the world is going on here. So we did. We protected principal, we pushed those positions out, and we sat there for a few months and waited until the market settled down. And from about October through December, we finished our trading out for the year.
Yeah,
And we had a profitable year.
Yeah, you did in 2010, and then you killed them in 2011. You did great. Is that the worst moment in the last 5 years?
That was the worst moment. Last August was not fun when we had there's no reason why we should have had a losing month last year. And those things are real hard on me. I take them
How much
very
money did
personally.
you lose last August?
We lost a 4.5% in the month of August for the month, but we still ended up the year at 53%.
So you lost 4.5% of the month in the month of August, which was your worst month.
Worst month.
So that must have been about $5 million, something like that, $4 or $5 million. And then you ended up the year up 53%.
We'd had some really good months up to that. We'd had some really good months up
You
to that.
call yourself a trader. Look at you over there. Seriously.
Seriously, this is not.
Listen, Karen,
I used to-
we usually start at 7 a.m., but obviously you can do things that he can't do. Let's just start at 8:30 Central when the bell rings, and we'll go to about
Sure.
9 o'clock. We'll get all this taken care of. We'll go to
Okay.
breakfast. We'll come back at 2:30, wrap it all up. Right, dear?
Sure, that'll be fine.
You don't need me.
No.
Okay, seriously, you don't need me. Again, I can't, only because I've been there. Like, and I've seen every tick for the last, something like 30 years trying to figure out, and I've watched people constantly adjust and tweak and overmanage and things like that. You don't focus on daily. You look at your P&L, but your focus isn't on your P&L. Your focus is on your numbers.
Yes.
Your probably
absolutely.
your standard deviations, whatever you want to call the numbers.
They are numbers to me. They are literally numbers to me. So it's that again. It's a big game board, and I don't mean to belittle it, but it's a process. So we are all managing that process, so that we don't get involved with, oh my gosh, we're losing here, or we're making this much money, or it becomes money when the paychecks are written at the end of the month.
But you really concentrate on your net lick at the end of the month more than your net risk.
Yes, we do.
I mean, you're always
Yes, we
conscious
do.
of your
Yes,
risk,
sir.
but a lot of retail traders will always say, oh, I'm risking $1,800 here, and that's too much risk for me, even though I want to make $400 on that $1,800. It's just too much for me. But you really concentrate on how much you can make.
Yes.
Inside
yes.
your comfort zone.
Yes. I know. I have some friends that say, well, I can only make 2% on that play for this month, so that's not enough. And to me, 2% is better than zero. So if that's all I can do for the month, I'm perfectly satisfied with that.
Based on the numbers that you've thrown out here today, and you and I talked about this earlier today, you set a target for your positions of what you suggested is around 15% for that 55-day period. And that's another thing that goes through your mind. And I'm just curious, when as you said, when the light bulb went off in 2009, 2010, and you migrated from risk-defined spreads to undefined risk. Okay, how hard was that transition, or was it just like all of a sudden you recognize, hey, I got to do this?
It was just as natural as it could be. It's just looking at the numbers, and this makes more sense to move. We can get further out and still make the same premium that we were making in the iron condors. We can get much safer, still make the same premium. Why wouldn't we do that?
We use the argument, Tony and I do all the time, to individual investors that if you define your risk, you increase your probability of success.
Okay.
I'm sorry. If you define your profitability, you increase your probability of success. You did that on your own, because that's not something that is generally taught in any kind of investor education. You had to come full circle. How'd you do that?
I really didn't know that I had done that until I met you. So it just made
please,
sense.
I'm going to have to get his head through the door sometime tomorrow.
Oh, I'm hoping to get a beret.
Oh, you play cards right, I'll get you one.
It just made mathematical sense to me to move in the direction that we moved. I did not do any great analysis. I just looked at the numbers and we just migrated towards.
Is your math background, do you feel like, listen, you can downplay your success as much as you want to, but there's something in there, there's something that clicked somewhere along because it's not normal what's happening here. So something clicked. Do you think when you look
See, now
back
some people would say instead of that, like not normal,
not normal.
like if they were conducting an interview, they might say something, it's extraordinary,
Okay.
or
No.
it's you've learned to do something that, even I, being, the great one, Tom Sazov, has not been able to do,
That's
as
a-
opposed to not normal. Like that
It's-
normal is just not
it's
right.
not normal.
Jill's
very
in the
positive.
next room. She would agree that I'm not normal. My math background and my accounting background, I've dealt with numbers my entire professional career. It just makes sense.
So were you able to take the stock market emotion, which is what takes down most people, is the ripping at your insides, the stock market emotion, the perceived risk. You were able to turn that into some kind of a numbers event and just focus on the numbers.
I got tired of that ripping the heart out. I don't want to go to bed at night feeling that way. I don't want to be scared of what's going to happen in the market. So we just kept working. How can we make this safer? How can we make it, in my mind, it's safer by going that far out of the money.
Karen, you mentioned 56 days or so. Are you all in at 56 days?
50%, she said.
50%?
Yeah, 50 to 70%, depending on what's going on in the
And
market.
will you have multiple months on? If you're at a comfort level, will you have multiple months on? Like, will you have October and December now? Or November and December?
Yeah, we'll have a current and out month.
Okay.
October is
30 days or so to go.
See,
November,
in
you're
November,
talking about
in
November.
November, by the time we get to October 30th, we will have closed most of our November positions down and brought the realized income back in October. So by the time we get into November, there's very little exposure there. And what's left is usually just so worthless, we just ignore it. It also takes up our buying power on our analyze tab, so we like cleaning that current month out, and then we'll
Freeing
be
up the
pushing
capital like any other
freeing up
retail
and getting
investor.
back into, and then we'll get into December and hit December hard.
Karen, there's some people, I know you use futures and futures options and not as much anymore, but do you ever use products to control your volatility risk like the VIX? Would you ever consider like a complementary or hedge position if you're short? I mean, you're short professional levels, hedge fund levels of premium. Do you consider like call spreads in the VIX, that kind of stuff, or you just totally avoid it?
We have done that in the past.
Yes.
I haven't done it recently.
Okay.
I may go back and look at it now.
I'm only
see.
saying because we're at the low end of sometimes
Yes.
commodities get to the low end of a range. So what's next? How linear is this bit? Meaning that can you actually scale bigger than you currently are, or are you at a good, comfortable number?
I am at a good, comfortable number. The fact that one of the funds, the money, the profit goes into, the net profit goes into the charity, I'm always interested. There's a potential that we'll start one more fund set up that way. And in my mind, that's it. I don't want to manage any more than that. But we still have room to grow.
How much of your life do you spend on the road working these charities? I'm just curious. Like, it's one thing to say, okay, I'm going to manage, gazillion short positions and all this kind of stuff. How often are you actually just...
Having the team we have gives me the flexibility. I'm in Africa about once a quarter, and I'm over there for 10 days, 2 weeks.
I think I'm in hell once a quarter sometimes. I don't even leave this room.
There are so many incredible little tidbits in here that I think people are going to grab for quite some time. Again, I'll go back to the simplicity of it all. There's this Karen, there's this popular idea that you need, in order to be successful, you have to outsmart or the game is rigged. Is the game rigged?
No, not at all.
Right.
I mean, and all the tools are there.
For free.
For free. That's
Who could build
except for
100
commissions?
Well, okay, but still,
still.
you're talking about hundreds of millions of dollars of business with.
I could not have done this in any other way. I could have tried to build a business. I couldn't sell enough bagels to do this, and this
That's
is
for
just,
damn sure.
And it's
Either
just
that or it's
opened
a
up.
lot of bagels.
It's opened up a world for me that is just amazing. It's just amazing that what this affords me to do, and that's the work in Africa.
Do you still love coming into work every day and just?
I love it. I love it. I love it. The first thing that hits my mind when I wake up in the morning, what are the futures doing? I just,
Don't worry.
That's
First thing,
every trader.
every single trader. So you've crossed over into the dark side.
I am happily in the dark side. I love it.
I'm Tom Sosnoff. He's Tony Batista. She is Karen, the super trader.
She is Thomas. I got to clarify one thing, just because our president downstairs is going a little nutty on me. The UGMA accounts into perpetuity is really till about 18 or 21, depending on your.
Thank you for ruining a beautiful close.
It was a beautiful close.
Thank you.
Depending on your state, TDA is only waiving those to the age of majority.
Okay, whatever. Fine. Thank you.
Yes.
Thank you, sir.
You're welcome.
I'm Tom Sosnoff again. He's Tony Batista. She's Karen, the super trader. This segment will be archived, and I hope, Karen, that you can come back for years and years and years to Tasty Trade, and we can have this this discussion. I could do this discussion. We've already sat down for a couple hours. We could have this discussion once a week for the rest of my life, as far as I'm concerned, because you have no idea, to experienced traders, what this means to us.
That's what's so fun to me. I have no idea.
Right.
I'm amazed that
You're too
you
damn-
asked me to come back.
You're
I'm
too
just-
damn innocent. You're too damn. You're too normal. Something's wrong, Tony. Tony, something's wrong.
Yeah, I think you
You're
said
supposed to be like in a mink coat.
You
know.
already told her she's not normal. It's okay,
Okay.
Tom. Enough said.
So
You see what I have to
something's
deal with
wrong.
every day.
I'll leave with that.
Thank you so much for coming
Thank
to
you.
Tasty Trade Studios, and thanks everybody for watching and for enjoying both of our shows tonight. And we will see you back tomorrow morning at 7 a.m. Peace.
Peace.